Today I have 8 great trend following trading strategies for you that you can trade on the 5-minute time frame, the 1 hour, the 4 hour, or the daily. So regardless whether you are a swing trader or a day trader, you can use those strategies on your markets and your time frames. The first strategy is the trend line flip or the trend line bounce. So technically we have two very similar trading strategies here for you. And the power of trend lines comes really into play when we combine it with other confluence factors such as pattern trading, price action, and support and resistance. So what do we have? We have a trend line here. You can see the trend line has been tested multiple times, once, twice, 3, 4, 5 times, and the market is back at the trend line. Then we also have a local trend line here. You can see it's not a very steep trend line, but it helps us really nicely define this pattern that we are building, which looks like kind of a head and shoulders, right? We have the left shoulder, then the head, and then the right shoulder. Left shoulder, head, right shoulder. And where this is happening is even more interesting. It is happening at a previous resistance area. So this was a very important swing point in the past. The market is coming back into it. The market tried to break out, but within just 2 or 3 candles, the market fell back below the range. We had another attempt to cover the high, but you can see the market was not able to take out the high, which is a very bearish signal. Then we fall into this long-term range, which is a distribution range, and distributions are often at the beginning of a market rolling over. So this is now giving us great information that a breakout, or when a breakout occurs, then a trend following to the downside is very, very likely. When we zoom in, you can see shortly afterwards we had the breakout, the retest back into the previous lows, and then the rejection. The rejection is here really the key to this pattern. You have a strong bullish candle, then the pin bar rejection, and then the strong bearish candle where the market accelerates into the downside. At this point, usually where the pullback and the break and retest traders get in is after the first bearish candle here, the first strong momentum candle. Typically stops will be placed here above the area. It's nicely protected by the support level, by the recent high, and also by the trend lines. And so therefore, your stop loss can very nicely be tucked away here and be relatively safe. And afterwards, you can see the new trend unfolded. This is a very typical scenario that the trend unfolds in such a strong manner. The reason and what often happens is that after such a long distribution, after the market is going sideways, after an extended period of trending, very often you can see that the trend reversal afterwards is really, really strong. There's a lot of unwinding going on. So the people who bought the market, the buyers are slowly starting to look for targets and for exits, especially after the market hit the resistance here twice. A lot of those buyers are now going to probably exit the market and new sellers are coming in because the price is now really, really high. And it led to a reversal in the past, the same price level. So two things come together, the unwinding of the longs and the new positioning of the shorts. And that's why you can often see such a very strong decline. So it can really pay off to study those patterns and to be very selective to find the right patterns, because then you may realize a large reward to risk ratio. We can also use trend lines in a different way. So here we have an active trend line. We have 1 touch, 2 touch, and the market is just the 3rd time back to the trend line. So the market is clearly going down, and in the past, the market bounced off the trend line. Another thing that helps to build confluence, because sometimes trend lines are obviously a little bit more subjective because you can draw trend lines in so many different ways. However, if you can find a confluence point between a horizontal level and a trend line, that can improve your setup quality. So you can see in the past, the market put a support in here as well, and then it acted as resistance. And now you can see we had a support, one support again, and then here now it may act as resistance again. So we are in a downtrend. We are looking for shorts away from the trend line and also shorts after hitting support, now turning into resistance. We can zoom in and you can see the market is currently in a neutral zone. So we have the support level here. We have 1, 2, 3 times support and we have resistance here. At that point, this is what I would refer to as a neutral zone. I would not look for shorts or longs right now. For a long, the market should break above this area and retest it. For a short, the market has to break below that. However, I would favor the short side because we are overall in a long-term bearish trend. Then what we see is the breakout occur. Breakout traders may now jump on it, but also there is always the likelihood and the possibility of a retest. And you can see we have a very, very similar pattern. We move into it, we have the doji pattern and then the strong acceleration. This is a very, very common break and retest pattern. You have deceleration and acceleration at the level. And what you typically want to see is strong selling away from the level. Don't make the mistake to just sell because the market hit the level. You need to make sure that the market is showing you signs of bearishness coming back into the market. And then the initial drop is often, not always, but often very, very strong. One of my favorite ways to trade trend following is using the pivots. Before we keep going, I just want to quickly let you know that I have started a free trading newsletter which I'm sending out every Thursday. Every Thursday you get a new email from me with trading tips, charts and other very important tips that will help you improve your trading. As a thank you, I'm also sending you a free ebook after you have signed up for the newsletter. The link to that is in the video description and also in the comments below. And now back to the video. And here I am on the 4-hour time frame and I have turned on the weekly pivot point. And the green line is the weekly central pivot point. And what you can see is that it works really, really well as a trend filter. So when the price is above the green line, you only look for longs. When this changes, the market dips below the pivot, you look for shorts, right? And this is true until here. We break above it, we move higher. Here we trade a little bit around it during the range. Then the market falls back below the pivot point, we retest it as resistance, and then the new downtrend unfolds. So the pivot can be a very effective first filter. And what you will often see during a trending market is that the market keeps retesting pivot points as support and resistance. In case of a downtrend, here we are on the 1 hour, and we are still using the weekly pivot. The market moves into the pivot, rejects it. Then we have the trend following sequence. We move back into the pivot. Looks like the market is finding resistance once again. A lot of struggling here, lots of deceleration. Suddenly we're seeing strong bearish momentum come back into the market. And then you can see we retest it once again with lower highs. And after the breakout below the support level, the market makes its next move, its next trend following sequence. So this is a very good way and a very good tool to have as a trend following trader. You can either use the weekly or the daily central pivot point. Next, I really like using the Bollinger Bands. If you've been following my channel, you have seen me using Bollinger Bands years and years in the past, and they are great for trend following. Here I have activated the regular Bollinger Band, the default setting, 20 period, 2.0 standard deviation. And in a downtrend, the market is here in a downtrend, what you see is that the market is very close to the lower Bollinger Band, but the market is not able to touch the upper Bollinger Band. And this classifies a strong downtrend. In such an environment, you want to look for short re-entry opportunities. You could, for example, see that after a strong bearish phase, the market made a pullback here, a sideways phase. The sideways phase is not able to reach the upper Bollinger Band. Then on the continuation breakout, this is where you could look for re-entries. So right around the trend following breakout here, we have the retest and afterwards the next trend sequence here again. And then this changes. Now the market is changing and pushing into the opposite side of the Bollinger Bands. So clearly a very different picture. And if you see that during a downtrend or in a mature downtrend, the market is suddenly able to pull and stay at the opposite band, that's a very different signal, and that's a very important bullish signal. Here once again, we have a strong uptrend. You can see the market is never touching the lower Bollinger Band, and we are always staying somewhere between the upper band and or the middle band, which is the 20 moving average, and the upper band, until the market is breaking through it. We're testing the lower bands, and then the market completely shifts. So if you see a very strong uptrend and then suddenly the market fails to reach the outer band and then moves all the way into the opposite band, that should be a very big heads up. If you are long, you definitely want to think about getting out of your trade, because that's not a very strong, healthy trend signal. As I said, one way to use it would be for trend continuations. So you see the market is coming here from a downtrend. The market pushed all the way up into the opposite band. Then we have a correction phase. The correction phase hits the middle band. And then on the breakout, this could be your continuation. I will talk about strong and weak corrections in later parts of this video, because it's one of the most important concepts to internalize as a trend following trader. However, we can see we have a very weak correction. The market doesn't move lower at all. We don't break the moving average. We don't even come close to the lower Bollinger Band. And then on the trend continuation, on the breakout, you can see the market make a new leg until we have the Bollinger Band contraction. Classic continuation is next. We have a downtrend, then we have an accumulation pattern. The market made 3 consecutive higher lows. We break above the resistance area, retest it. Then you have your first trending leg. If you have missed the first trending leg, or if you're just looking for re-entry opportunities, you can wait for the market to give you a correction phase. Don't just chase the market when the market is going up. That's not a good idea. You will ruin your trading. But what you will see is that in a trend, it is very natural to see those corrective phases. We wait for them. A great tool to add is the 20-period SMA. And what you will often see is during a trending market, the price will stay above the moving average, not able to touch it. And then once the price reaches the moving average, this is a pullback situation. This is your corrective phase. Then you can apply different filters. For example, you don't want to see the market violate the moving average too deep, too much, and that could help you identify good versus bad correction phases. In this case, we have a very shallow corrective phase, so the market is not pushing lower as much, which is a good signal, because if the market would have been able to trade lower a lot, that could signal a lot of profit taking from the buyers or a lot of sellers getting interested. And that's not what you want to see in a bullish trend. In a bullish trend, you want to see short, moderate volatility corrective phases. Then you have your high momentum breakout. You take out the highs, which is important. Stop-wise, you typically have your stop loss underneath the breakout, maybe even underneath the moving average. And then you are looking for trading the next impulsive wave. We can also add the pivot points, and you can nicely see the market trades above the pivot points. During the pullback, the market retests the pivot point here as support. And then you can see the market pushes higher, makes another small correction. We retest the next pivot point. Another great opportunity to add to your position if the market breaks above it. You can see that's where the second corrective wave happened. Then the market moved higher into a distribution phase where the price is now trading around the pivot points and around the moving average. So you can see there's a very, very big difference between what is happening here, the market trading around the pivots and around the moving average, versus here retesting the pivot and just briefly staying on top of the moving average, not really violating it very deep. So this is some concepts that can help you improve your trend trading and your understanding of the markets. And to add to that, we can look at advanced wave analysis, because I think this is really helpful to get a general understanding of market sentiment. So we always want to analyze wave strength and wave weakness. So here the market is clearly in a downtrend. In the downtrend, the market moved lower, and then we have a corrective phase. But just look at, first of all, the height. Obviously, the red box is much higher, which means that the market sold off very strongly in a short amount of time. The market dipped and sold off quite a lot. Whereas here, first of all, the box is much less high. It's not even half as high, which means that in the next corrective phase, there was not a lot of buying going on. And also, compare the length of the different boxes. The box here and the box here, the green and the red box, are very similar. The green box is even a little bit longer, which means the sell-off took much shorter time than the correction. So in a short amount of time, the market sold off a lot. Whereas here, in a longer amount of time, the market was not able to move higher. So this tells us that there's still a lot of selling pressure probably here in the market. This is not enough to just blindly sell the market right now. But if we get the right short signal, then this would make this a high probability setup. Again, what we do is we add the pivot point. We are on the 1 hour, just like here. And we add the weekly pivot point. The market is retesting the pivot point from underneath. We have a triple top. You can see very strong rejection here. And then what we're doing is we wait for the breakout. We have kind of a break and retest entry, very strong selling, stop area depending on your level of aggressiveness. Do you put it all the way above the highs, or do you put it just above the trend line and above the support level? That's really up to you. And then you can see we have another hit, and then the market is selling off. So you can see, you can wait for the initial retest, you can wait for the retest afterwards, you can just trade the breakout. There's no right or wrong. Different traders prefer to trade those markets and those techniques differently. However, the prerequisite, the conditions, the wave analysis, the momentum analysis, the patterns, the tools that you can use are very similar. How you get into the trade and how you place your stop loss is then up to the trader himself or herself. Next, Quasimodo, which is also sometimes called the 1, 2, 3 pattern, but it's a very interesting pattern. So what we see is a clear downtrend once again, right? The market is selling off very strongly and then a weak correction. We have learned in the last example that this is now a good sign that if we get a bearish breakout, this is a high probability setup. We have the breakout, a lot of traders are going to jump onto this, right? And then they are frustrated because most of the stops will be hit. If you get short, your stop loss will probably somewhere up here. Maybe if you're very safe and you played very conservatively all the way up here. But for the most part, I think most stops will be hit here. Very frustrating. A lot of traders now believe this is a fake out. However, it's not a fake out until the price takes out the previous highs. And that's really, really important. A lot of traders make the mistake of blindly buying the market if they see something like that. They believe this is a fake out. However, if the high and low structure is not changed and if you don't make higher highs, this is not a fake out. This is still overall a bearish market. The market was able to break out with strong force. Granted, the rejection happened and the market was not able to stay below the lows. However, this is already a strong signal. What you do in this case is that you either wait for the market to take out the highs, then this turns into a real fake out and you look for longs, or if the market turns around and shows you more bearishness, you look for short continuations. This is the fake out or the potential fake out. We didn't take out the highs, then we come back, we retest or we make a pullback here, then we break out, retest and sell off. So the problem here is that a lot of traders, of course, they get in short here with the breakout, they get taken out and then they are frustrated. Maybe some will reverse it because they think it's a fake out and then they're trapped once again. However, it's really important to wait for the market to clear structures. You need to make sure that the market is taking out highs before you get in short, and that can save you a lot of trouble and a lot of headache. Now I want to talk about the MACD because it's a great trend following tool. The MACD is based off moving averages, which are generally very, very helpful in trend trading. One thing that I would recommend is to look for MACD divergences. A divergence is when the price action is giving you lower lows, here in this case of a downtrend. However, the indicator is already signaling you that the price action is not as strong on the bearish side as the chart may suggest. And the indicator is giving you higher lows. So the indicator and the price action are not agreeing. However, a divergence on its own is not strong enough to just start trading. Here we had a divergence previously, right? The market was making lower lows and the MACD is giving you higher lows. However, at no point did the market make any bullish attempt to reverse the chart and the trend. We didn't take out highs. We didn't break the moving averages. We never had a strong bearish or bullish phase, and at no point did we make any breakout attempts. This changes here. We break above the moving average after the divergence. We take out the previous high, which is here. The market broke out above it and then the trend changes. So one of the most important things is that you are not one-dimensional in your trading and you don't only trade one signal. You don't only trade a trend line. You don't only trade a Quasimodo. You don't only trade a wave pattern. You don't only trade whatever it may be, a Bollinger Band reaction. You have to make sure that you have multiple signals stacked on top of each other happening at the same time or very close together so that you can verify it's a robust signal. And this is a very, very important tip, not only for trend trading, for many other trading strategies and approaches in general. The last one is stochastic writing. And this is something that many traders get wrong. And this is really, really dangerous for your trading. And on the other hand, it can be really beneficial for your trading once you understand the power of this signal. So what we have is the stochastic here on the price chart. And a lot of traders believe that when the stochastic goes above 80, you call this overbought, and the market will reverse after that and move lower. However, if you just take a moment to analyze the stochastic and the formula and the math behind the stochastic indicator, you will see that this is not the case at all whatsoever. And the opposite is true. When the market and the stochastic goes above 80, it just signals a very, very strong trend. And the last thing you should be doing is go against the trend. What you should be doing is look for trend continuations into the direction of the stochastic. So above 80, you look for longs, below 20, you look for shorts. And this can save you so much money by avoiding going against the stochastic and looking for opportunities with the stochastic. So here the stochastic dipped into below 20, and the trend continued to the downside for a long time. And I really recommend you take a look at my other stochastic video on this YouTube channel. If you're interested, I break down the stochastic and I show you exactly how the stochastic is calculated. And then you will realize that going against the stochastic is a really bad idea. Another example, we are on the 30-minute time frame and the stochastic is coming from the 4-hour time frame. So we're kind of using a multi-time frame strategy here. And the stochastic enters below 20 here, and afterwards the market still keeps selling off and selling off. So traders who go against the stochastic will have a hard time because the stochastic exactly shows you the opposite actually. Of course, we can add other tools, moving averages, pivot points, we can look for patterns, look for continuations. However, the point of this part of the video is to help you understand that stochastic or any trading indicator in general is often more than it seems, and many traders have a wrong understanding. So before you start using any indicator, I would always recommend to just take a look at the formula, how it's calculated. Usually it's very simple math and it's very easy to understand. So even if you are not a math crack and a math nerd, you should be able to dissect and understand pretty much any indicator out there. And that's it for this video. I hope you learned something. I hope any of the 8 trend following strategies or tips gave you something new that you can apply to your trading. Maybe start with a backtest on demo. And if you found this helpful, let me know in the comments below.